In this video, we're going to break down the key components of a day trading strategy. This is designed for beginners. First, let's talk about the setup. Now, a good day trading strategy is going to follow a clear set of rules and a checklist. So this is going to help remove emotion and guesswork from all your trading decisions. Now, all good strategies, it doesn't matter if it's day trading, swing trading, position, doesn't matter. It uses some type of tendency that the market has. Momentum, volatility compression, mean reversion. Now, the strategy we're going to talk about is going to use two different time frames. A higher time frame to identify the overall trend and a lower time frame for your entries and your exits. Now, the most important rule, especially when you're starting out, is trade in the direction of the trend. So we want to see the price trading above the 50-period EMA on the higher time frame, and that's going to indicate an uptrend. Now, higher highs and higher lows on the chart will also confirm an uptrend is in place. That's a price action way of determining the trend. Now, in day trading, the higher trend can be the daily chart, but think in terms of a 3 to 5 times your trading time frame. So if you're using a 5-minute chart, I'd prefer at least a 30-minute trend time frame. 15 minutes, consider 45 minutes to an hour chart. Whatever it is, just stick to it. So once an uptrend is established, we want to look for buying opportunities when the price just pulls back to a previous high that's become support. So think of that as price is mean reverting. Now, this area is going to be our buy zone. Now, we don't just blindly hit enter here. We want to wait for something specific to happen, such as a chart pattern. So in the strategy that we're going to talk about, we want to make sure that we do see lower volume confirm the consolidation of price. We do not want to see any strong moves against the overall trend direction. So our entry rules. So let's say price pulls back to a former area of consolidation. We could call that support. We would enter on a breakout above the previous candle, and that's if we have volume support or momentum. We can also use a break above a simple trend line for entry, or even a hook of a momentum oscillator, such as the 310 oscillator. This is a good way of doing it as well. It keeps the emotions out of it. Now, risk management, huge. We have to manage risk. So we want to set a stop loss at a level that invalidates the trade setup. Now, since we're day trading, let's keep it simple. Let's just use the low of the candle or the bar that you use to enter the trade. And you would like to look for a reward to risk ratio of at least 2 to 1 on your profit target. Now, proper risk management, this is going to help control the emotions during losing trades because we know we're going to lose. But just ensure you decide what % of your account to risk on each trade and stick to it. Consistency is vital in day trading. So let's take a look at one example. It's a very straightforward strategy. I want you to notice on the left here, we have a 1-hour chart. And on this chart is the 50 EMA moving average. And we're going to use this for trend. On the right-hand sides, we're going to use a 15-minute chart. And I also put the 50 on here as well. Here's our volume on both sides. So at this white line is when price is broken above the 50. And you can see that 50 starts to curve upwards. So we are only going to look for longs on the 15-minute chart. So this white line here is when we can start looking long. So like I said, we've got a few different ways that we can trade. So here you do see that price has come in to a previous level of support. Price had bounced off here, came back up, came down, and started to move back up. So one of the entries we talked about is just a simple trend line break. A trend line break, nothing magic. It just shows there's been a change in the rhythm of the market. So just take this here. And it's that simple. Anytime price breaks above and closes above this line, we'll take an entry. So you can see at 12:15, we have an entry. You can see as well in this little consolidation here, we see a lower volume in through this area right here. And that's what we want to see. All we would do is enter our trade. This is a large candle, so we're going to have a bit of a larger stop. And this would go at $73.56 minus an extra penny or two. Now, there's so many different ways to take profit. You can hold the trade throughout the day and close it 15 minutes before the end of the session. You can use the higher time frame and target previous support or resistance areas, depending on if you're going long or short. Here, you'd be like way up in here. And price does get up to here if you're willing to hold it over the course of several days, including the weekend. But for day traders, you probably would not do it. So in this area here, you might close it. It all depends on you, on how you're going to trade these. So we're going to look at one more example. We're still going to stick with crude oil. It's a very popular futures market, especially here at NetPicks. Again, we're still looking for longs only, as you can see from here. Price goes up, pulls back down into an area that was resistance, now support. You can see all this consolidation in here. Price comes down into here. Again, it depends on how you want to trade and enter these. It is difficult because you really can't draw a trend line on this one. But on these, you could just buy stop the highs of these candles and get triggered into the trade that way. That's an easy way of going about it. I also talked about using the 310 oscillator. And this is a momentum oscillator. And the way this would work is you would use a hookup in the fast line, which is right here. Now this is trading view. So you may have to use a modified MACD. And I'll put the settings up here as well. Price comes down into this area here. We look for a hook up, which happens on this candlestick here. That would be your entry. You would enter here, your stop would go below. And again, how you exit the trade, you can look for 2-to-1 reward to risk ratio. You can target previous resistance zones. There's so many different ways to exit a trade. You can even use, if you're going to use a 310, just look for a hook down. And that's going to happen on this candlestick here. So how you exit your trade, a lot of it's going to have to do with your trade psychology, how you handle trades going against you. But in a day trade, a general rule for me is once momentum starts to disappear, I want to get out, take my profit. And I can always find another entry another time. And to build confidence in any trading strategy, you got to test it out on historical data through a process we call back testing. Now, this is going to give you an idea of the potential profitability. It's not going to be guaranteed. And it's going to help you master the rules before you risk capital. That's probably the best part of back testing. You master your rules. So wrapping this up, in summary, the key components: use 2 time frames. This is great for starters. Okay, only take trades in the direction of the higher time frame. Buy at support during the uptrend. And you want to enter based on something specific happening. And your risk management rules, make sure you use them, make sure they're solid. When you master these components, you're going to be on your way to consistent profits as a day trader. Not every day, but consistent. But keep in mind that no strategy you're going to trade is going to work 100% of the time. Losses are going to happen. They can happen in a row. So never risk more than you can afford to lose. In closing here, I hope this video has provided you with some insights into day trading. It doesn't have to be overly complicated. Most importantly, follow your rules. Talk to you soon.